one of the first things I'm just looking at, we're all kind of feeling and seeing, is this incredibly embarrassing disconnect between the real economy and the markets, and the S&P in particular. There's a fantastic sentiment indicator from the University of Michigan, and it started in the early 70s, and it's been tracking kind of the Main Street zeitgeist for decades. And it just reached recently its lowest sentiment reading in its 5-decade history. And what's interesting about this isn't just a tracking of sentiment, but whenever these sentiment levels reached this low, and in this case, the lowest in history, it was always followed by a recession on Main Street. So these are kind of the economic risks, along with the currency risks and the banking risks and the geopolitical risks, and of course the market risk. But when I look at the broader markets right now, where it's heading with the gold price and the gold direction, which is extremely bullish for me, of course I'll explain why, but the bond market is the broad market. I know it kind of creates eye rolls, it's kind of boring, but it's actually globally a $145 trillion global market, which is 20 trillion bigger than the global stock market. And most importantly, bonds represent debt, and their yields represent the cost of debt. So bonds are the wind beneath the wings of the S&P and this bond market. And that bond market is snapping. And I think the proof of that is in the fact that sovereign bond demand is tanking. And we see that with the yields on government IOUs, or government sovereign bonds, the 10 years out of the UK Gilt, the US Treasury, the German Bund, the Japanese JGB. It's the same in Italy, France, Canada. They're the highest yields in decades. And this is because trust in these sovereign IOUs is the lowest in decades. And it's not just me saying this to be sensational. I mean, even Bloomberg, their 5-year annualized return on aggregate global bonds was the lowest on record. So it is a bond crisis. And what does this mean for the markets and therefore for gold? Well, again, rising yields equal rising debt costs. And this isn't a market driven by liquidity from debt, but the cost of that liquidity is spiking. And again, this affects every asset class. In the markets, it certainly affects stock buybacks, which are driven by cheap debt. And when the cheap debt becomes higher, that affects the markets. CapEx is driven by cheap debt to be successful. That's affected. I've written for the last couple of years about the warning signs in both private equity and private credit markets, because they are also driven by cheap debt and start to cough and choke when those yields and debt costs rise. So I think those are very real needles pointed at this very overvalued by every metric stock market. But even the global derivatives market, it's 10 times the size of the pre-08 derivatives disaster, and it's 4 times the size of all global assets. That too is driven by low rates. So when rates get higher, deleveraging starts. That puts risk in a very risky and often ignored derivatives market. But our government is also driven by cheap debt. So we're seeing a real liquidity crisis. Many people have forgotten, even at the end of last year, the New York Fed Reserve Bank was giving massive cash infusions right around Halloween. 50 billion was infused into one of the banks. And then another 100 billion came in less than 2 months of daily cash infusions. And by the end of the year, the New York Fed Bank was removing the limits on cash infusions. About 240 billion in a single day went to like JP Morgan or HSBC and Wells and B of A, et cetera. So there's risk even in the financial sectors because of this bond market, which signals a liquidity crisis, which signals a massive crisis in the markets. And I think, you got to ask yourself, why is Berkshire Hathaway 400 billion in cash? They're all tied. Ironically, the stocks and the equities are tied to what's happening in the boring, high-yielding bond market. And what this means for gold, which is obviously the thing that I look at the most. Well, of course, most know in a bear market, traditionally, when stocks fall, bonds were the safe haven. And traditionally, when stocks fall, gold is sympathetic, as it was in 2008. We saw a 30% correction in gold before it ripped back up. Those are traditionally, but traditionally we were never 39 trillion in public debt. And what we saw, if people think back just as recently as March of 2020, before unlimited QE, stocks and bonds fell together. And during the higher for longer kind of crisis under Powell in 2022, we saw the worst nominal returns in stocks and bonds since 1871 in the US. And more recently on Liberation Day last April, when the tariffs were announced, well, stocks and bonds fell. There was no bid in the bond market. So stocks and bonds are no longer yin and yang. They're correlated. That's a very important signal. And what we're seeing now in the bond market means former buyers are now sellers. The most obvious examples of this is China at its peak had over 1.3 trillion in US treasuries. Now it's about 650 billion. And Japan, which was the largest holder and is the largest holder of US treasuries, sold more US treasuries in the first quarter of this year than in the last 4 years because they all needed liquidity to support their currencies. So going forward with gold, the key issue, gold could continue to sell off in a bear market to cover margin calls or other things, often needed liquidity. We see that over and over. You sell your most liquid and best asset to pay for the sins of your other assets. And that may or may not happen. I think there's going to be more of a move now why gold is more favored than U.S. Treasuries. But where gold goes secular in the next moment is very clear. Because we've never had a debt crisis and a bond crisis and therefore a liquidity crisis of this magnitude. Never. Nothing like pre-08, nothing like the pre-dot-com era, nothing like 87. There's nothing to compare. So whatever moment, whatever needle from private equity to private credit to rising yields pops this market balloon, I think the direction is going to be less to U.S. Treasuries or bonds as a safe haven and more to better stores of value like gold. But, I'll close with this. Market up or down, I think gold wins. People say that's, of course, Piepenburg selling the book. But if this market mean reverts, I don't think the world's going to rush again to U.S. Treasuries issued by an issuer that's $39 trillion in debt and weaponized that U.S. Treasury 3 or 4 years ago. So I think we're at a major, major turning point. But even if the market goes up and it doesn't pop because it's supported by massive liquidity from the expansion of the M0 or M2 money supply, you could technically make this stock market immortal, but only at the expense of debasing the currency in a very hyperinflationary or high inflationary setting, which is also good for gold. So I can be agnostic whether we save this pathetically bloated, overvalued market or whether it mean reverts. In either case, we're looking at inflation as the end game, and we're looking at debasement trade as the end game. And we're looking at gold going secular higher. That can be ignored right now on these retracements. But from the bond market to the stock market to hard assets to gold, it's all connected. Central banks aren't stacking silver like they're stacking gold as a store of value or basically the de facto reserve asset. I think for silver, it's a little bit different. I think silver has got technical and basic supply and demand forces. And I think the buying opportunities in silver really depend on your individual time horizon and profile. I mean, I see silver well over $300 coming very quickly. So whether I buy silver at 70, 90, 100, or 60 is not terribly important if I'm a longer term player in the space. Now, I'm an investor in silver, not a trader. And I look at the ratios for the entry and ratios for an exit. But even when I exit, usually when I'm looking at a ratio of at least 30 into the high teens, gold-silver ratio, I'm just going to use it to buy gold, which will be undervalued at that compression. Because I'm looking at these metals as monetary metals. But to your point, there are fundamental forces of supply and demand outside of just the monetary system and the industrial, in the military, in the energy sector, which require silver. And those demands are higher now than ever in a conflict-ridden backdrop that we're sitting in. We all know that we've seen 5 or 6 now consecutive years of 200 million ounce silver supply deficits. That's not just something to memorize. It's something you got to think about. That's over 1 billion ounces in supply deficits. And we look at the COMEX, the registered or available silver versus the open interest or the demand for silver. The ratios are off the charts. I think we're heading towards a cash settlement only COMEX. And if you look at the lease rates on silver, my entire career was rarely above 1%. Now we're well over 8%. So these are supply and demand forces that are really important. I think the military industrial demand, remember, silver is a byproduct mined metal. You can't just create supply with the push of a button. And solar panels, electric vehicles, military, that's even more demand now than reported. So this massive supply deficit at a time when silver is now on the critical minerals list as of last year, in a war where silver is an element for these weapons and EV adoption is rising and solar has more installs, it makes for an even stronger bull case on supply and demand. And I'll end with this because I think it's important on the technical side, and I'm not a trader, but of course I want to look at the direction or the signals. I see a bullish rather than bear case in silver when it dips beneath its 200-day moving average. I know that sounds kind of wonky, but it's very easy to track. And the last time silver fell below this average was in April of 2025. And that was just before the metal, which was then trading at 27, ripped north by over 200%. Historical multiples, historical new highs. And prior to 2025, we saw a similar bullish signal when silver tipped below the 200-day moving line. That was in 2020 when silver was around $10 or $11, and then it ripped. And in 2022, the same thing. It touched that moving day average line when silver was at 17 and then continued to go north. By the way, that same 200-day moving average indicator where it dips below and then rips is actually the same thing in gold right now. So both metals at a technical level are positioned very well despite the retracements. But again, it's about your profile. Are you investing as a trader? Are you looking to leverage long and short? Are you looking to arbitrage? Or do you see these metals as monetary solutions to openly dying fiat money? I look at them both. Silver will have a better beta trade to gold when gold hits another bull market run, which it will. I'm very bullish on both. Of course, people are going to say that's selling your book. But again, if you're a longer term investor, you can afford to be the most important thing of all when you're investing. That's patience. And patience comes from conviction. And the conviction comes from understanding the debt crisis and the debasement trade to monetize that debt. It's really a fat pitch to me. And I'll keep saying this because we haven't gotten started on the bull market yet in gold. And so silver will track it, but for different reasons.